guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. Today, we're going to be doing one of our famed, our one and only preliminary analysis. We're going to be analyzing Netflix, ticker symbol NFLX. I'm going to be asking all the questions, Fabio, as always, with all the wonderful answers. Going to be taking a look at the business, the industry, the financial position, plugging it into our discounted cash flow model, capital mindset standards. So without further ado, well, what are we looking at here today? And to start, what is this business? Who are its customers? What are some industry tailwinds, and then as well as some headwinds to start?
So essentially with what we're looking at precisely here, it's, well, Netflix, Austin, come on.
Yeah.
You threw me off with that question. I was like, wait, this guy doesn't know Netflix?
Well, I mean, of course I know Netflix. I'm just, it's the standard first question, it's priming. It's priming everything,
Well, I guess if Netflix were to need an introduction, it's basically a streaming service that you subscribe to through the internet, right? And then you can have access to it on any device, whether it be your computer, your cell phone, your home movie theater, etc. So it's pretty easy to obtain a Netflix channel, and Netflix has expanded across the globe and it's in many different languages. So the United States is their prime, most valuable market. That's, I think, where they get the most profit per user. And then I think the second is the Euro region. So let's take a look quickly at the performance of the business so far from a stock price perspective. So this is kind of to give us a gauge as to what the market's kind of pricing in for Netflix. So over the past 5 years, it's done really well. And since inception, it's done exceptionally well. This is actually one of the best performing stocks in the time it has existed, right? And over the past 10 years, I think it's one of the best performing stocks in the market. So
yeah, if I know that Netflix really kind of revolutionized the streaming service, and now a lot of other companies are sort of following what Netflix really pioneered with this specific model itself. I guess the kind of question now, and this is something that we may ascertain or may not ascertain, is there still future potential here present inside of Netflix? Is there still a reason to really be bullish when it comes to Netflix in terms of the business itself? So
there's always potential, but it's whether or not the potential is reasonable and if the price is appropriate for that potential. So looking here, Netflix has corrected quite significantly right here in the short end, and it's down about 21%. But if you take a look at the full year, it's still up about 8%. So, it's not really down for the whole year. So on a PE basis, it looks expensive right here, but that's on a PE basis, right? That uses GAAP numbers. It's not on a cash flow basis. And actually, we're going to have a little bit of a discussion about that when we get to the model, because it's quite important. And I always preach, and Austin preaches as well, that nuance is very important. Austin, you've learned that through your investing journey thus far, that nuance is one of the most important things an investor must take in. And every business can be very different from another business. So one business, we may use cash flows. Other businesses, we may prioritize another form. So we'll get to that later, but that's kind of a hint of what's coming. So this business is very asset light as far as the physical assets go. The assets really lie in the IP. So we did a video about Disney, right? And we discussed about how a lot of the IP of Disney is very valuable on the balance sheet, right? It's a lot of their assets, and it's hard to actually value some of this IP. There's different ways in which we can do it. There's something called, so there's economic goodwill and accounting goodwill. Economic goodwill, and I think I had this explanation.
I was literally about to ask that. I was like, okay, so in this instance, where my mind immediately goes is I'm likely going to see a lot of goodwill on the balance sheet here with Netflix then. Intangibles.
Accounting goodwill, not so much, but economic goodwill may be on their own company's balance sheet, right? So what they use, not gaps related. Okay.
Would you kind of explain now the difference between economic goodwill and accounting goodwill, and then specifically how economic goodwill relates to Netflix itself as well?
So economic goodwill is a measure that a business internally will make as to the value of an asset over periods of time. So this can be, for example, IP. So let's say they produce a show, Squid Game, And then they come to a estimation as to the value Squid Game will produce over the life of the IP. And this can be in the form of retention. So they ascribe some sort of measures. And again, this is not GAAP, it's not standardized. This is Netflix for Netflix's sake. And then accounting goodwill is a little different. Accounting goodwill, for example, is based on the acquisition of a company. Netflix will have some goodwill because we've got to talk about some of the acquisitions that they are making. That's going to be very interesting, but that's more like what the goodwill it entails, right? It's the acquisition of a business and it's the implied future value of those returns, right? Of the cash flows that they'll generate. So real quick, going on to Netflix, we got to discuss first, what is their current path forward? I just got off the earnings call, right? And it's actually on YouTube. It's very easy to watch. It's basically like an interview base. So you can see the faces of the people speaking. So the company is actually positioning itself in a manner that it is targeting the globe, right? So it's actually focusing on a lot of what they call non-English IP. And so they're using their cash pile to actually develop a lot of content to target basically the rest of the world. And they're trying to grow that because, again, the United States is basically a mature market. They're looking to grow elsewhere in the world. So on top of that, they're making deals with, for example, Walmart, that they're actually selling a lot of the products from the IP that they have, similar to how Disney does it. So Disney, has the Disney princesses, and you might see Disney princess dolls or whatever. And then same thing with Marvel. So you see the toys, the Marvel toys. So they partner with other companies. So Netflix is doing the exact same thing with their IP. So that's good to see, because that's going to be it's going to be high margin for Netflix. And that's another avenue for growth they have going forward. What else they're going to do is they're investing heavily into video games. So Netflix sees this as a big part of the future for Netflix, right? And I tend to actually agree that it may be a worthwhile venture for Netflix to develop an in-house studio and then offer video games as a service, basically. So you subscribe to Netflix and then you get also video games, right? I think that would be very compelling. It'd be interesting to see how they would manage those costs going forward. They will have a good amount of competition, but the competition is welcome. I think Netflix can provide a lot of new content, and then they're thinking about how they can target existing consumers with their IP, well, leveraging their current IP and then making video games out of it. Okay. So for example,
Stranger Things, like a Stranger Things video game, something
precisely
like that. Okay.
Precisely. Exactly that. So they're going to make, they've stated as much that they're going to make more acquisitions in this specific area going forward, but they're going to be selective about it. Now, whatever that means, let's just take management's word for it that they're going to be selective. But the point is, management is interested in further expanding down this niche and acquiring more businesses in the video game category.
So now my question is, and you just kind of indicated that you're not entirely too sure what management strategy is here, but in terms of taking in mind the macro of Netflix's current strategy, will we be kind of seeing exactly a strategy whereby Netflix will be seeking to acquire IPs that AAA publishers have within their own platform? Like, basically what I'm trying to ask is, will Netflix be offering, let's say, FIFA or Madden or Call of Duty on a subscription basis, and then take a profit of that? Or is Netflix, apart from offering that as well, because you've already indicated that they want to build their own games, will it just be exclusively their own games that they want to build? Or if you don't know, that's
no, it'll be their own games. They've stated that.
Okay.
They're not going to pay, for example, EA to have FIFA or Madden on their Netflix platform. They're going to focus on developing in-house content centered around their IP or new IP. And then they're buying up a bunch of different little studios here and there to actually develop more IP, both in child entertainment. So that's something they spoke about, how child entertainment actually doesn't need much investment into it, and in order for actually to achieve success. It's actually kind of like quick and easy to produce content. It's not like a big production product like The Witcher, for example. So that was interesting to kind of get management's perspective on that. Okay, so now going into a quick discussion on the accounting, because I think it's very important that we discuss that. And I think this is a good lesson for everyone watching. Normally on this channel, we talk about how it's the importance of understanding GAAP, when it's what it is, what it's useful for, right, from the accounting perspective, and what it's designed to do. Okay, so the design is to add a level of transparency so that investors can understand a business and kind of look at all businesses the same, right, and think of the different line items, right, and kind of standardize the process of analysis, right? So we take that, and then we also want to look at the cash flows, because the cash flows at the end of the day are what can be returned to us as the owner of the business, right? Because a lot of GAAP, it's not that GAAP fakes the numbers, it's that GAAP can change how the numbers look, right? Specifically regarding the cash inflow and outflow, because it's the accrual basis of accounting, right? There's cash accounting, and then there's accrual basis of accounting. And the accrual basis of accounting can be confusing to those who have not studied accounting. And that's understandable, okay? So those of you who are CPAs or have an accounting background, shout out to you guys. And you guys might want to maybe comment a little bit on that to explain to the rest of the audience who maybe aren't as familiar with accounting practices, that, some little tips or tricks. Anyways, when you look at the cash flow statement, this will tell you the cash in, cash out. When you're looking at Netflix, though, we have a different story. Okay, so they continuously invest cash into new IP, right? So you could think of this as investments, right? But it's not actually being categorized as investments. So if you look at the cash flows from operations, right, they're very low. And actually, I think I will go ahead and
something that I kind of want to ask now, and this is just sort of a question.
Yeah.
In this instance, then, for specifically Netflix, would book value be something that really matters to you in this instance then?
No, not at all.
No. Yeah. I kind of figured that was probably the answer, because we'd be dealing with a lot of intangibles. But I was also kind of curious too, if there was sort of a merit to just considering book value in terms of Netflix here. But I guess not. I got my answer there. So no worries.
So taking a look right here, I'll actually pull it up and show everyone. All right. So is this clearly visible for everyone? All right. So there's this.
Yes.
All right. So let me actually zoom out and then zoom back in. But right here, this change in other operating activities, right? This part right over here, you see how it's quite large? Well, included in that, the model's aggregating this. Included in that is what they're spending on new IP. Okay. So each year, Netflix will grab cash and then just spend it on new content, right? And then they're trying to spend on new content so that they can keep and retain current customers, as well as attract new customers, right? Because their business model has high recurring revenue. So because of that, we have to then consider the potential value going forward far into the future, right, of these cash flows. Eventually, will they be able to stop spending that cash? That's another question, right? We can ask that question. But in this case, a good representation of the actual performance of the business, in fact, is GAAP net income.
Wow. Okay. Would you actually kind of go into a little bit more detail and just sort of unpack that? Because that's
so
yes.
The actual development expense of these new IP isn't actually being expensed per se as an expense on the income statement, but it is a net negative cash expense, right? It's a cash expense. Cash is leaving the business. They're paying for the production of these new IPs, right? So the GAAP net income is taking into account the costs of running the business, right? You got the sales and the cost of goods sold, et cetera, very high margins because it's pretty much a software business. And then down the line, paying the sales, general administration expenses. And at the end of the day, they have a positive net income. The cash flow statement, I think the cash flows are about 1/5 the net income, right? 1/5 the net income off the top of my head in the most recent year. And even last year, when it was a high cash flow, it was about 2 billion versus a net income of Yeah, actually, the cash flows were pretty similar because they weren't spending a crazy much more on the other expenses. So it was fairly similar. And I think it was double, or no, not double. Yeah, right here. I just checked for myself. It was a 1,800,000,000 in cash flows, right? Yeah, so 2 billion there. And yeah, so it's almost like 50% more, right? So the net income was 50% more than the cash flow. So the cash flows are always perpetually lower, right? And that's basically because the cash expense of actually spending on IP is an actual cash expense. Therefore, the cash flows are going to be lower, right? But it's not necessarily.
What is the ramifications to owners then in that instance? Because
that's the second conversation we need to have.
Yeah.
Can they stop?
Can they stop? Can they stop
investing in new IP?
Oh no, or else
Can they ever
Netflix.
Stop?
No, because in my personal opinion, if they decide to stop, Netflix ends up dying.
Okay, so
unless it's
Or is there a point in the future in which they can benefit from the scale? Like, is there some point where, you know, they cap the investment, for example, at $20 billion a year in new IP, and everything else they just keep as profit? You get what I'm saying? Remember, IP produced in the past can always be used into the future. It's already made, right? It's made, and there's some expenses that can occur here and there. Maybe some actors have royalty agreements, etc. But for the most part, let's keep it simple. IP produced in the past can be used indefinitely into the future. So that's the beautiful part about, you know, television or movies, TV shows. They can be used into the future forever. All right. So once it's made, it's good. But will they forever be spending the same amount on development? And then will there be a point where it kind of caps out and grows slightly? And then everything else, basically what I'm saying is, will they scale? Will they achieve full scalability, right? They've already shown that they are, because the cash flows have reached positive levels. Cash flows have finally reached positive levels, okay? Which means they are spending all that on development. And then after that, they still have several billions of dollars left over, right? After considering all of the expenditure on new IP. Okay. Am I making sense with that?
Yes.
Okay. So we're having a different conversation now for everyone following. We had the conversation about, you know, gap versus cash flows. Now we're having the conversation about, well, what are the implications of that? Because will the cash flows ever be to the amount where we would be satisfied, right? Will they ever at one point not have to spend that level of cash flow? Or do we think right now, we can agree or disagree, do we think right now they will forever need to spend that level of cash flow year on and year out?
Well, this also kind of brings up another point too. Are we potentially looking at Netflix in a potential growth stage? They might not even be at full maturity yet in this instance here. They might be within their growth stage, even with the exceptional returns the stock has already had. They might be in their growth stage.
But remember, separate the business from the stock. Separate the business from the stock. The business may still be in its growth phase. Yes, exactly. I think I'm leaning on that, because when I'm seeing that the company is capable of scaling by the sudden pop in positive cash flows. Cash flows are now becoming positive. The net income has been positive for quite some time. Again, the net income isn't accounting for certain things. The real cash expense that they are expensing, like cash is leaving the business to develop new IP. That's a real expense. You can think about it on a cash flow basis. That's been rising. And despite it rising, they're still cash flow positive. So that shows me that they actually are scaling. And then I think management was kind of hinting that at one point, they're going to reach that level, that phase out level, where they're going to be at scale. And then anything above that is basically just going to come down into the balance sheet, which will be an interesting moment for Netflix. But I don't know when that will be. But I don't really have a prediction for you there. So let's go to the model and kind of start talking about some potential projections we can make.
Kind of curious to see what the model's going to put, if I'm being honest.
So ignore these growth rates right here. We have to adjust these. But let's take a look at analysts, because analysts are far more intelligent than us. And they
They're
have it at a buy rating.
Fabio.
They're
The
infallible.
analysts are infallible.
And they have a 24% upside from here. That's what they believe, right? With a price target of 673.66. And let's take a look at these projections. So in the middle projection, we discounted it at 12%, right? I'm not even going to include those buybacks. That's share dilution. I'm not even going to include it. Or you know what? I'm going to do it. Whatever. All right. Never mind. It's gone. It's basically there. So if you can assume the average growth rate over the past 5 years, and let's be precise, because I know someone out there is going to be like, that's not what it says. All right. If they can do what they've averaged out, you can expect, yes, a 12% rate of return for the next 10 years. But that is a hefty assumption we're making, because that's a growth rate of 26.7% for 10 years compounded. That's nothing to sneeze at. Will they be able to do that? Yeah, maybe not. All right. So, but remember when I told you, Austin, dilution accretion?
I do. I was actually thinking about this as well. I was thinking about how we could, how dilution accretion sort of plays into the story. It plays into the nuance here of Netflix right now.
Yeah.
So please, would you kind of explain that to us?
What the model's telling me is that they're utilizing more debt, right, than equity to fund the business. That's why it says debt heavy. All right. So dilution accretion is a measure that we use, that it should be used, right? And it's designed to help me decide whether or not the dilution by the business is actually helping the business or me as the shareholder, or it's hurting me.
And the way that you evaluate this is that you are seeing on a per share basis, cash flows grow greater than the amount of shares that are being issued, correct?
So the measure, how you read it, is if dilution accretion is a positive percentage, then yes, it is good, right? Then that means the dilution is not harming you. Okay, if it's positive. It is only to be used, let me repeat this, is very important, because we're repeating this, or we're saying this in other videos, because eventually this model will be out for people to use. And these videos can help serve as kind of a guide on how to use it. It is only to be used when the company is diluting you. When the company is diluting you, then you can look to the dilution accretion measure, and it will tell you whether or not the dilution is actually harming you, because not all dilution is bad. Blanket statements are not welcome on Capital Mindset. Everything is with nuance. It depends. Everything depends, right? So, oh, by the way, do you think Netflix needs the money?
Do I think Netflix needs the money?
Yeah, like to dilute you. Do you think they need to dilute you to get money? You know where I'm going with this?
Yeah.
Yeah.
Yes.
So yeah. Do they need it?
Do they need the money? Yes, of course they need the money.
Do they need to fund? Do they need to fund the business with dilution?
No, they don't need to fund it with, but they do need the money. They do need the money. It's just about where that money's coming from.
Right? Okay, but my point with that is they don't need it. No, it's like they're not desperate for it. They're not saying, oh, I need the money to survive to pay the bills. The lights go off if I don't dilute shares. Yeah, that's the point I'm trying to make in more videos, because of misinformation that certain creator made. Where they said that if a company doesn't need to dilute you, they're not going to dilute you. No, they're going to get the lowest cost of capital. I know some of you have been saying, or maybe thinking right now, wow, you said that in a bunch of videos. Yes, because new people come in, and then I want to repeat that because they might not have seen our older videos. All right, I repeated to you that book value per share, I don't care about it. Okay, don't care about it. So just so everyone knows, what I did here is I made some adjustments, because in this case, we want to look at the company from a different perspective. I've adjusted the cash flows to reflect more like a GAAP net income. Okay. And the reason why is, if, for example, I looked at the cash flows, because of that expenditures that they're doing on the new IP, the buy price, if you even discount it at market average rate of return, would be less than $100, like close to I think it was like $12. Something crazy. Because if you look at it from that perspective, and again, understanding the nuance of what it is this business is like, it probably reckons a second thought as to why we would discount the cash flows per se. But it is a valid conversation to have, which Austin and I kind of played with here, that, well, why does that matter? Will they ever be able to stop making those investments? So then maybe we should discount it using the cash flows. And in that case, if you are of that school of thought, and I'm not telling you that you're wrong, by the way, if you are of that school of thought, I agree with a lot of, the sentiment, and I actually don't think it's wrong. I think it's actually neither one is perhaps all right and all wrong, but it wouldn't be an investment for you, because under that school of thought, you're never going to actually realize those cash flows. Those cash flows probably will never reach you, or they're too far into the future that it's not worth it at all right now. Right. So again, but even using that, understanding, and we're switching up the numbers a little bit, making that adjustment, the 26% growth rate going forward for 10 whole years is quite an ask. Okay. So let me be very clear. And we're only discounting it at 12%. We don't have much room for error, right? For outperformance. So already this is telling me that it's not going to be something I'm too keen on investing in. If anything, it would be a small little speculation within my portfolio, and kind of like a watch
like
stock.
A tiny little
nibble. Like a super small nibble, and I'd be watching it. And then if it ever came down significantly during a bear market, I would consider it, because I love the product. I use the product all the time. People come over, watch it on the movie theater, and then we have a great time. The Witcher. Have you seen The Witcher, Austin? I'm a huge Witcher fan.
I saw bits and pieces of it. I really enjoyed the show Narcos. I thought Narcos was fantastic. The one from 2016, 2015 with Pablo Escobar. Fantastic.
You just like to see the darkness of this world.
I do. Because I also happen to like Stranger Things too. I think it's a good show.
I've never seen that.
Pretty good. I like it.
Never seen it. I know that's blasphemy, but never seen it. Okay. So, do you have any specific growth rates you want to kind of attach? Because I'll say, for example, I'm not really putting any other growth rates, because anything really below 26%, the model is going to tell me it's not a buy. And if I discount it any higher, it's going to say no, sir. For example,
sort of keeping up with the theory now that Netflix could be potentially in its growth stage. Why don't we just plug in 40% for the growth rate and cash flows over the next 10 years? Now, is that possible? I have no idea. I'm just curious to see what price it would
you see, return. 40% would be quite drastic. That would be,
because 26 is already pretty,
if I did that here,
serious. Yeah,
that would be quite a large sum. So basically, take this, for example, and that's what you're assuming the profits will do for the business as a growth rate for 10 years. Yeah.
Let's lower that down to 30.
Okay, so let's go back to 15. So 30%. And to show you what you're saying by saying 30 over 10 years, that's a 1,278% increase. So about a 10x, 12x, 12.7x. If you're assuming a 30 growth rate. So you remember what you're saying. Okay. So that allows you to kind of put it into perspective as to what it is you're implying by that growth rate. Right. That's a 12x.
So now let me actually see for another growth rate. This is actually a good exercise too, because this is kind of helping me really conceptualize the model. Let's actually put in another growth rate for 12%. And then can you change the required rate of return to 12% too?
So you would need to get this thing at $200, which if we take a look, let's see how long ago it was at that price. I think it was at that price quite a long time ago.
At the dip? No, yeah, right about 18, at the end of 17, 18.
Yeah, around there.
Actually, so I think my mother bought into Netflix right at that point. She hasn't sold at all. I actually think she bought in right at the end of 17.
Okay, so she's up quite a bit, and good on her. I just say for someone trying to get in now, the risk definitely is there. So if things don't go, remember how generous I'm being. I'm not doing the cash flows. I'm not. I'm basically ignoring the cash flows and going for the accrual basis of accounting, and then kind of under the understanding that yes, that may be the wrong way of doing it, depending on your thought process as to whether or not they can ever change. But the GAAP net income is kind of telling me the underlying actual profitability of this business without the added expenditure. That's why I'm using GAAP net income. So
yeah, and it also kind of comes down to the camp as well that we've been consistently referencing the entire video, which is really, is Netflix still in the growth stage of the business itself?
I
That
think
will really
so.
actually give the color to whether or not we're going to see that continual change in operating activities on their statement of cash flows, which is them paying for those IPs, paying for the production, real cash leaving the business itself. And as you were just saying, you do still believe that Netflix is in its growth stage as a business. Everything that I'm seeing, this is a preliminary analysis, of course, live. It looks to me too like there's like I can kind of piece together the story that Netflix is still potentially in its growth stage. So it definitely interests me. If the price comes down pretty dramatically, I'm definitely going to buy.
So here I can see, that they're debt heavy, right? So the dilution rates hasn't been that drastic, but they are using debt. They're utilizing debt. The total debt ratio, improving. Long-term debt ratio stayed about the same. Long-term debt to capital is improving. Debt to equity is also improving. Liquidity ratios are fine. They're fine. They almost got enough.
Margins are also improving too. Wow.
Margins should be improving because they should be scaling. So that's indicative.
And then
of scaling.
also as you were talking about earlier, as they leverage their IPs and get product offerings like that will contribute to the margins, everything.
So return on equity and return on assets, this is all our DuPont analysis right here. So we're taking a look here. This is rising, the net income margin. All right. So pretty good here on the profitability ratios. They are improving, right? They should, I expect them to continue to improve going forward. All right. Taking a look here, we see a good earnings quality, good earnings quality, good earnings quality, bad earnings quality.
And then good.
back to neutral. That's neutral. But I guess you could say it's good. Book value is going up, but we don't really care. You're probably never going to get this company at book value. If you ever do, wow, congratulations.
If the Fed raises the interest rates,
not even. That would be quite a cheap stock. I can tell you that right now, because this is not a company that should be ever trading at book value. Book value would be very cheap. Something would have to be very wrong. I don't think the market would just give you that kind of free money. Okay, something would be very wrong in the economy or something. All right, and we don't really care about inventory because they don't have inventory. All right, so going back to the final stage or final thoughts before we close off on Netflix, do you like the business? Yes or no, Austin?
Yes, I do. I do like the business.
Would you buy right now?
No, I would not buy right now. I would have to wait until the Fed raises the interest rates. I would have to wait until the Fed raises the interest rates and the prices go down.
Are you just parroting other people? What is that? What are you doing?
No, it's been a long night for me. But if the price went down pretty dramatically,
ladies and gentlemen, I think Austin's losing his mind.
I think I'm losing my mind too.
All right, so your investment thesis on Netflix is entirely correlated to Federal Reserve policy.
No, it's more so. It's more so the business is a fantastic business. If the price comes down pretty dramatically, then I will definitely consider buying at current prices. I always say this. I've been told I have a strong vernacular and that I need to, but at current prices, I need to make too many assumptions that I wouldn't exactly feel comfortable investing right now, but that might be subject to change as I kind of learn about the business more and study the business more. Because for those of you who don't know, whenever we make videos on these and the stock piques my curiosity, I actually go and do my own research and read more about it. But what about you, Fabio? What are your thoughts about this?
Business, very solid business, but separating the business from the stock, I wouldn't be buying this. Too many risks. I'm going to be a happy customer. That's where they'll stay for now. That's my relationship with Netflix. I do not own Netflix in any capacity, nor at work do we own Netflix. I can tell you that much. So yeah, but I would be interested in owning this business at the right price. Yes.
Well, you heard it here, folks. This is the Capital Mindset Show. We are your hosts, Austin and Fabio. If you like what you've seen here today, please be sure to share the video, Really, really helps out the channel. Please be sure to follow our Twitter and Instagram at capital_mindset and visit our website at capitalmindset.org. Like, comment, and subscribe, and we'll see you guys later. Take care.